Hi there. In this quick explainer video, we're going to answer the frequently asked question of if I use my self-directed IRA, 401k, other type of retirement plan to invest in alternative assets like real estate, private equity, trust deeds, mortgage notes, cryptocurrency, precious metals, am I incurring taxes and or penalties? And the answer to the question is absolutely not, providing that you follow all of the rules and all of the procedures. So for example, if you were to buy a property with your self-directed IRA, step one, of course, would be to open and fund a self-directed IRA. And many investors are funding their self-directed IRAs through maybe a rollover from an old 401k with a previous employer, or maybe a 403b through a savings plan, or maybe they have an existing IRA and they simply want to transfer funds from point A to point B. It's important to understand that the act of transferring or rolling over funds from one firm to another does not trigger any type of adverse tax consequences or penalties. You're just simply moving from one retirement plan to another retirement plan. Now, you have to make sure you follow the procedures properly, because if you don't execute on rolling over or transferring your funds in the right way, then you could create taxes or penalties. But in most cases, investors are following all of the guidelines properly, moving money over into a self-directed IRA. And then at that point, they're directing their custodian to send funds out for whatever type of investment they're looking to make. So for example, if you were to buy real estate with your self-directed IRA, you're not borrowing against the IRA, you're not distributing funds from the IRA and therefore creating taxes and penalties. You're actually using the IRA and buying a rental property, for example, or maybe it's a fix and flip type transaction. So as long as you're following all of the rules and guidelines, you're not creating any type of taxable event, nor are there any penalties associated with your investments. So if you're buying a rental property, for example, cash leaves the account. In return for that cash is a deed to the property. And then going forward, you just make sure that all of your expenses are paid for from the IRA. And then, of course, all profits go back into the IRA. And that's really important to follow this process so that you maintain the tax privileges of the self-directed IRA, which can be very powerful. If you do invest in, let's say, another type of asset like a private direct investment, private stock in a company, cash would leave the self-directed IRA to purchase the private stock. In exchange for the cash would be stock certificates. And then going forward, all profits from the sale of said stock or dividend income would flow back into the self-directed IRA. No taxes or penalties. It's important to understand that self-directed is just an industry term. So it just indicates that your custodian, your financial institution that you're working with, will allow you to select your own investments, will allow you to make decisions on behalf of your own IRA, rather than relying on someone to make all those decisions on your behalf. I hope you enjoyed this short explainer video. Tune into the next one. Until then, keep leveraging compounding interest in the absence of taxation.